Hi everybody, we're here at another Lunch and Learn with Gerchick Real Estate. Today we're going to talk about to pay taxes or not to pay taxes. It's really not what that means. It means, are we going to defer our taxes? Are we going to act like big time investors? Are we going to use the 1031 tax deferred exchange, and are we going to do it correctly? That being said, our preferred referral partner is IPX. IPX I've been using for all of my exchanges with my clients, even my own exchanges, for almost 20 years. We're very blessed to have Rick here. He's going to lead you through it. Any questions, email me at any time. On that note, Rick, I'm going to let you take it away.
All right. Well, thank you, Linda. Thank you for the introduction. And yes, I'm the local representative for IPX. We're a 1031 exchange facilitator. And today we're going to talk about some a little bit more advanced issues as regards to for investors for 1031 exchanges. So we're going to do a little tax update. Some of you may know what's going on in the tax world. We're in the middle of a presidential campaign, and things are up in the air on that, so we'll cover that. We're also going to cover reverse improvement and built-to-suit exchanges. Everybody knows what an exchange is, but these are the more related to investor type of exchanges. Partnership issues, seller financing combined with 1031, related party issues, personal property exchanges, investors. We're trying to go and get through all these items, but depending on how much time we have. We'll start off with this. This is what's going to happen, or what's happening proposal-wise for the 1031 exchange. Some of you may know or may not know, but it is up for reform. So at this point, and things could change because we're in a presidential campaign year, but we have the House that's committing to a full repeal of the 1031 exchange. So what does that mean? Well, some of you may have used 1031 exchanges in the past with some of your transactions. If you have, then you know what the benefit is. It's not just affecting my paycheck, it's going to affect the whole industry and the economy if it does go to a full repeal. Because a lot of motivation behind, just so clear a little bit too as well, 1031 exchange is not something that you're avoiding taxes. All it does is defer it as long as you're willing to purchase another property or investment property. So that could be commercial, residential, as long as it's held for investment purposes, it can qualify for a 1031 exchange. Now if you have a client that has a real estate portfolio that has a large amount of gains in it, is he going to be motivated and prompted to sell that property if he has to pay a huge tax? It can be 20 to 30% that he has to pay. So if it's $1 million, that's a big check that you have to write. So his motivation might be to sit on his real estate and not do anything with it. So a full repeal would definitely hurt the economy. The government will get, if he sold that property, that tax at that particular moment. But if he buys more property and continues to build up his portfolio, down the line they're going to get a lot more taxes. Plus it helps out a lot of industries, helps out real estate agents, helps out title companies, helps out myself, I'm directly related to 1031, and investors, so anybody that's around real estate. So that's the House's full repeal. Treasury is going to just kind of limit it to $1 million. So what that means is if you have a gain of under $1 million, you can still do a 1031 exchange. If it's over that, well, you have to pay your taxes on it. And then the Senate is kind of doing the same thing, but they want to manage it more directly. So right off the top, this is where our website is. IPX 1031 Exchange. It is full of information. So today we're going to talk about a lot of things in regards to build-to-suits and reverse exchanges. But if you need some resources or updated information, our website is great. But the main reason why I'm showing this today is because there's a tab on our website that's tax reform. So if you're in support of the 1031 exchange, go to our website. There's a pre-written letter that we can send to your local congressman to just kind of keep him informed that this is something, remind him that this is something that's important to you as far as what it has to do with 1031 exchange. Okay, so this is some tax updates, and I'm saying it's an update, but you can see the date there, it's 2013. It is an update because a lot of people don't know about this particular tax. This is the Affordable Health Care Act tax. It's 3.8 on certain investments incomes for taxpayers over $200,000. or $250 if they're married. So what that is, anybody know what the Affordable Health Care Act is? Anyone want to take a guess, being what we're right now? What's that? Obamacare, yeah. So we refer to it as the Affordable Health Care Act, but most people know it as the Obamacare. So anything that you sell a property on, you're going to be paying an additional tax now since 2013 of 3.8 over and above federal, state, and depreciation recapture. So that's bringing up more taxes that you would have to pay if you were to sell. So just a little side note on that. More is tax review is the new 20% rate is progressive. So what this means is that rules stack ordinary income first, then capital gains. So I'll show you how that works out. But basically anything $50,000 is taxed at 15%, and then the remaining taxed at $30K is at 20%. So it's depending on how that goes. I'll show you, most of you people looking at this numbers and like, what is that? I'm a visual person, so I have a slide. Oh, maybe you don't have a slide, I took it out. But it's basically that your first part of it, which is ordinary income, is only going to be at the 20% rate, sorry, the 15% rate, and then anything over that remaining of it is at 20%. So it's not just a flat tax. These questions are going to be answered by your tax advisor. I'm not a tax accountant, but this is just some updates that happen with the tax rulings. Okay, so reverse exchange. How many of you know what a reverse exchange is or heard of the word reverse exchange? Show of hands? No. How many of you are familiar with just a 1031 exchange? We all are kind of familiar with that, right? Well, I'll give you a real quick rundown on what a forward exchange is, or delayed exchange. Forward exchange is basically where you have a property that's an investment property that you want to defer that capital gains tax. So you go through a QI company like ourselves, because you cannot touch the funds. You touch those funds, they become taxable. So they have to be deposited into an exchange account at close of escrow. So you want to set up that 1031 exchange prior to close of escrow on any investment sale. So it sets up the funds. The exchange funds go into an account at close of escrow, and then they're held there until you find your replacement property or properties. So what a reverse exchange is, just the opposite. You might have come across, and that's where it's important to investors, and that's where I spoke to Linda earlier today, that this is something that might be a topic for investors. You might find the property that you're in love with and it's a great deal, and you want to acquire that prior to you selling some of your older properties. So that's where reverse exchange comes into play. And that's what we're going to talk about a little more in detail here. But basically it's the same as forward, but in reverse. Very clever name. So then you would basically acquire the property up front, and then gives you 180 days to sell your current property. Okay. So parking title to replace that property. So you have the exchanger, and then you have the exchange accommodator title holder. So EAT. We just shorten that up to EAT. Okay. So you'll see that on the next display here. So phase one is that the funds, the loan exchangers for the down payment or entire purchase. So when you're purchasing a reverse exchange property, the loan is going to be it's going to be very difficult to find the loan. That's going to be the first thing that you're going to have a problem with, because we're basically going to be the note holder. That EAT is going to hold title to that property. Now, are we in the business to own properties? No. Are we a bank? No. Is a lender going to give you money to an EAT or a qualified intermediary company that's holding these funds that we just created for you to purchase that reverse exchange? No. So the biggest thing on a reverse exchange is that you have to come up with the cash to, for that entire purchase. You can get some hard money loans, but you got to make sure that there is no recourse on that note, which that they can call it the property back. So then the seller and the replacement property cash goes back and forth, and then it's held with the EATs. Okay? Any questions on that part so far? All right. Interrupt me if you can. This is very complicated stuff if you're not that familiar with forward exchanges. So then the EAT holds the title and to the exchanger's property, and then the relinquished property is then sold. So once the relinquished property is sold, when I'm referring to the relinquished property, I'm referring to your current property, your current inventory that you want to sell. So that's the relinquished property, and then the replacement property. So it's held there until 180 days until you find your replacement property. Now, on a normal forward exchange, you have close of escrow, you have 45 days to identify the opposite of this, your replacement property, and you can identify a few different ways, but the most popular way is 3 properties that you identify. And then you have 180 days from close of escrow to close on that property. So in the reverse exchange, same thing, same numbers, but everything's in reverse again. You don't have to worry about the 45-day identification period because you already know the property, you already have it under the EAT. You're just basically got 180 days to sell your relinquished property or your current inventory property. And then you use those funds to acquire and change it out of the EAT into your name or your corporation or LLC. Sounds like pretty easy, right? So it's very simple. We have, and here it is, that makes it a little bit easier. So this is phase 2 of that. You got the exchanger. So my client is always going to be referenced as the exchanger. If you're a realtor or you're an investor, you might have a different title on it, but when you're speaking to the qualified intermediary, we're going to reference that as the exchanger. Okay? So then the relinquished property, that's the property that you currently own on your current inventory. The buyer, of course, somebody's going to buy that property, cash to the QI, which is qualified intermediary, which would be us. Then cash goes to the EAT. The EAT is that entity that we form. Usually it's an LLC that acquires that property. And then the replacement property goes back up to the exchange. All of these are done through agreements and assignments through escrow. Now, why is it important to have a qualified intermediary or an EAT own that property that you want to purchase before you sell your relinquished property? Anybody want to take a stab at that? Well, let me rephrase that. Can you exchange into a property that you currently already own? No. So that's why the EAT is created. Now, because if you own that property, the IRS, the 1031 exchange, is a deferment of tax, but as long as you're acquiring new property. So if you bought that property up front and it's in your name and you're waiting to sell your property, it's not going to work because you own title to that property that you already acquired. Now you're selling your property. Now you want to exchange that funds into that new property that you already acquire. You can't do that. So you cannot exchange into anything that you currently own. I get this call every other day on clients that, oh, I just sold my property in California. I made $1 million. I want to buy a property in Arizona for $500. I want another one in Prescott for $200,000, and then the rest of it I want to put into my my piece of land that I already currently own because I want to develop it into single family. Everything is good on the first two, but the latter part is not because they own the land already. And they're like, why? I don't have anything on it. I want to build on it. They own titleship of that land, so they cannot develop it with that funds from the exchange. They can do it on their own funds, but they just can't use deferred tax funds to do that. Okay, so that's where the reverse exchange comes into play. So then, to get a little bit more phasing into a little bit more deeper, you got the exchanger, you got the relinquished property. The deed and note goes into us, the EAT. It's not technically us, we're just kind of holding it and keeping that in there so it's safe that you can exchange into it. Qualified intermediary holds those funds, and then the seller of the replacement property, and then replacement property back to the exchanger. So that's just the whole flow of the whole transaction. Again, you have 180 days to accomplish that sale of your replacement or your relinquished property. Okay. And then there's agreements and assignments for that, and then the exchanger goes into title to basically now has the equity in the property. Now, there's another way. The reason why a qualified intermediary company like ourselves does this transaction for you is because it's keeping it compliance. Now, if you have another unrelated member of that you would like to do this under the same way as an entity like us, you can still create your own reverse exchange. Now, this is something you have to do with somebody you trust and you don't have any working relationship with. So that's basically going on the side of the street and saying, hey, I want to buy this property, I got the money, I'm going to buy this property and my cash, going to put it in your name and have you hold it for 180 days until I sell my property. And then when I have my money from this property sale, I'm going to take it out of your name and put it in my name. So, you think that's something that you'd want to do?
No.
No. So that's why you need a company like us, because it's going to be all agreements and assignments and everything is going to be in compliance with the IRS. This is actually a ruling that the IRS came up with reverse exchanges. Happens a lot in the commercial arena, the larger transactions. I had one out of San Francisco a few months back. It was a hotel purchase for $100 million. And they just had to have it because it was a sweet deal apparently for $100 million. And they had other assets under their portfolio that they were going to sell and then use those funds to defer into this property. So they had to buy it on the flip of a dime, They purchased it under reverse exchange and then gave them the 180 days to close 2 properties to exchange into it. So those type of transactions in the commercial world happen a lot. And it does happen in the investor world as well, because you might come across like a 4-plex or a duplex. That's a really good deal. You have a property that you want to upgrade to it, but you may not have the time because it's very competitive that you may need to do a reverse exchange to acquire that property. So it's a very hot topic right now because a lot of economies across the country are doing very well and it's very competitive. So reverse exchanges are becoming more and more popular. Our reverse department actually here for the whole company, because we're a national company, is based here in Tempe. So your coordinators and processors are all local to handle that. All right, any questions on any of that? All right, we got a really lively group here today. Okay. Yes, this is all pretty crazy stuff. So this is just going to break it down a little bit more for you. Exchange your cash, the EAT to the buyer, and it's used to repay that EAT that we created up here and hold title with. Okay. We'll go into this now. How many of you, by a show of hand, have ever heard of a built-to-suit exchange? Okay, this is all brand new stuff. So a built-to-suit is another investor type of exchange. Now, just like the title, you might have heard built-to-suit before, right? As far as building a property to your liking. So this is very similar to that, is that you're acquiring a piece of property that you want to develop. And you want to use exchanger funds for that. So this is similar to reverse and similar to an exchange. But step 1 on this one is you got your exchanger, the relinquished property, direct deed to the buyer, okay? Cash goes to the qualified intermediary, an exchange agreement, and assignment of funds. Does that make sense? No, right? It will as I go along here. But basically what we're doing here is that we're buying a piece of property the same way as you normally would, but we're just using different titles to it, okay? So the exchanger signs the purchase agreement for the replacement property to an intermediary. So instead of buying that property, we're assigning it to us, or the buyer's assigning it to us, so that they don't have ownership to that property that they want to acquire, because they want to do what? Build a suit on it, right? Okay, so step 2 is we have that title now, the EAT, again. You got the seller, back and forth replacement property to be improved, cash to the exchanger. So what we become here, the EAT becomes basically, how many of you have done a construction loan before in the past? You know how they work, right? You have your plans in place, and then you have phases to the construction that the bank does deposits to it, like, okay, this phase you get $20,000, this phase $50,000. So as you go through the phases, the construction loan pays out the contractor as those jobs are completed, or needs to have those jobs completed. We become basically that. The EAT becomes that. So those funds are sitting there to develop that property that you don't have ownership to yet because it's assigned to the EAT. We maintain and hold that, but the difference between like a construction loan and doing a built-to-suit exchange is that we're going to be holding this title the maximum for 180 days. You're on a time limit on this. So that's the biggest thing I get with some commercial developers that they want to develop a property and they have this money that they want to land that they want to develop. Can they do it in 180 days? That's what they have to weigh out. Is it possible to get it done in 100 days? Or the other thing is that if you have $2 million but you want to develop a $5 million property and you only have to really have $2 million, you can use those $2 million to develop that land, and then it can do that within 180 days and exhaust those funds. You still need another $3 million, but you're going to do that through a loan or through something separate. So then you can close out your exchange or your build-to-suit exchange because you accounted for all your exchange funds to build that property. So you might be able to do that phase within 180 days. So those are the things that you have to explore and review once you're into something similar to this. Now don't be experts on this. We have actual structured department that will help you structure the reverse or the build-to-suit. This is just to give you that knowledge that these are things that are possible. You don't need to remember everything. You can go back to the website and check what I'm saying here again. But again, each situation could be different. So that's where we're there for, to help you out and structure those types of transactions. Okay? All right, let's move along here. So this will be step 3, which I kind of retouched on. But you got the E complete replacement property. And there's your time limit of 180 days. Now, there is, under the safe harbor is what it's saying here, That's another buzzword that's out there in the mortgage and the real estate world is safe harbor, and more under the 1031 exchanges. A safe harbor ruling is basically that you have X amount of time to do that property on 180 days. That's all that's saying there. You can look it up on our website to get more detailed information on the safe harbor rulings. And it's on a different topic. Okay, so related related partner party exchanges. So this is where you have partnership issues. Individual and corporate, where 50% of the value is outstanding in stock is owed directly or indirectly by or such individuals. So you got two corporations which are members of the same controlling group. Corporations 50 and 50% of the capital gains and profits. Okay, these issues come up all the time when it has partnerships. How many of you guys have been involved with a partner when you're investing in properties? Right. What happens sometimes on those partnerships? They dissolve, right? You may want to go your separate way. You had a piece of property for 10 years, 5 years. He may want to do the exchange, and the other person doesn't want to do the exchange. It becomes a problem because that partnership or that LLC is the taxpayer. So as far as the IRS knows, is that we have one taxpayer, and it was a partnership or set up similar to this, and now one entity doesn't want to do the exchange. So that's only 50% of the taxpayer that is doing the exchange and the other's not. So it gets complicated on that, and then we have to be structured. I don't know if I'm going to go through too deep into this because I don't want to bore you a little bit. Let me see if I can get to something that we can show you that. So, basically what they're talking about here is who are not related parties. So when I was talking earlier about the reverse exchange, and you can have somebody else purchase your property, somebody you would trust would be somebody that's related to you, not somebody off the street. But the thing is that you cannot use related parties. So you can't have anything that you exchange into that is a person that owns that's related to you. So even though that piece of land that I was saying that you own, he wants to take that $200,000 to purchase that property, well, you can't do that if the in-laws own it either. Or an uncle or nephew or niece owns that property. Friends, kinda, it's a gray area, but if they're a direct friend, not supposed to either. Or domestic partners, or entities own 50% less to the TP of their related party. So anybody that has interest in that land, okay? Complicated situations, but these come up a lot with the partnership issues. So if you have a property that you're looking at, the nuts and bolts of it is if you have a property that's in a partnership and you have a LLC and you're thinking about selling the property, speak to a qualified intermediary company to find out how to structure it prior to the sale. Because you don't want to do anything last minute like what they call a drop and swap, where you decide to drop one of your partners and then you become 100% owner of that property and then sell it. That's a no-no, and it's basically frowned on, and you could your 1031 exchange could be in default. So, but if you do it like a year plus 1 day prior to your sale, and you buy out your partner or vice versa, or you exchange the structure of the corporation and you settle that outside a title, and then a year down the line you do your sale, and you have it all structured properly that you want to exchange and he doesn't, or vice versa, or you both want to go separate ways. You can do that. But a lot of times what happens is 11th hour you're trying to resolve these issues, okay? Okay, so that's just going back and forth. I'm going to skip part of that related party stuff. Let's get to what I was just talking about here. Okay, so partnerships, that's what I was just saying. So you got a partner or an LLC that can complete an exchange. Partner exchanging into interest partnership. This is not exactly what I was talking about. The multi-member of the LLC is treated for federal tax purposes. Both are excluded being like-kind. In summary, the interest in the partnership or the LLC membership is never like-kind. So that's not exactly what I was talking about, but it's something to do with that your partnership interest is not the same because they're talking about interest in the partnership, not actually ownership of the partnership. Don't even, I mean, I'm just giving you that because it came up on my slide, but that's not exactly where I want to go. I might be confusion here on that side. So disregard entities existing, federal tax purposes only examples. So these are disregarded entities from federal tax purposes, went back to what I was talking about when you have that partnership issue, okay? So you got a single member LLC, And this one is H&W LLC in a community property state. And there's 9 community property states. Are we in a community property state? Yes. So there's the list of the community property states. So with this, the common law states in partnerships for federal tax purposes to disregard property and couple needs to be in a community property state. So when you have a single member LLC, a lot of them have properties that are in LLC, and they create that LLC for liability issues. And it might be, usually it's a single, or it's you're doing it as your husband and wife. So not an issue here in Arizona because you're in a community property state, it's covered under that. But if it was in any other states, then you have some issues on restructuring it prior to the sale. How many of you guys own properties or looking to invest properties outside of the state of Arizona or outside of these states? Okay, so you want to get to figure out the logistics on how you title a property in the states that you're investing in. So consult your QI or tax advisor for making an exit strategy on those properties so you're not going to get hit down the line. Or if you're thinking about selling it in the future, and get with the qualified intermediary or tax advisor to see how you can structure it properly so you're not having any issues at the last minute. Okay? Same thing for properties here. Okay. This one is another one. Living trust. We have a lot of living trust here in the state of Arizona. They're handled the same way as a single LLC because it's a community property state. Now here's a question that you may or may not know, and it's not on the slide. When your purchase or your replacement property is in an LLC or it's in a trust, what does the replacement properties have to be in? Same. Yeah. So like when you're doing a like-kind property exchange, the taxpayer, we're dealing with the IRS. All that they look for is the follow the taxpayer. So all they know when you're selling a property and deferring your capital gains tax is who was the original taxpayer. So if you switch and buy a property in a different name, you can still do it if it's a single member LLC and it's you purchasing on a property for financing issues. It's better to do that than the LLC. But we have to provide information to say that you are the same entity because the IRS only knows what they're receiving their taxes from. If they're getting taxes from an LLC, not you as an individual, we have to marry those two together so that they understand who's what. So to make it safer, when you're doing like-kind replacement properties, keep the LLC the same on the replacement property if you can. But for financing purposes, we understand that you might need to go back to your personal name because that LLC may not have any credit to qualify for it. Okay? Yeah.
That doesn't negate the 1031. So if you're going from one LLC to a different LLC.
Initially, it does actually put your purchase or your 1031 exchange in default, or it could put it in an audit situation where it has to be audited. As long as you have the proper documentation to show that you're still the same taxpayer, yeah, you can still keep your exchange current, but it's better to have it same, and then if you need to change it down the line, like if it's ABC LLC and you purchase your replacement property ABC LLC, that's clean, you're not going to draw any red flags, and that's exactly how the 1031 exchange, and that's how the IRS is going to look at it. Now if you go ABC LLC and you buy it under BCD LLC, first thing that's going to come up is that's a different taxpayer. So then they're going to dig a little deeper, and then they're going to dig a little deeper, and then you have to maybe, if you get in an audit situation, you have to explain yourself. When it comes to the IRS, they're a little different as far as if you're out on the weekend and you're partying and you're in the wrong place at the wrong time and you get arrested for whatever the reason is. You're protesting or at one of these presidential campaigns and you get arrested for whatever that is. You're innocent until they can prove you guilty. So most times you get released. If you're under an audit with the IRS and they see something that they don't like about your tax return, you're guilty and you have to prove your innocence. And if you don't have the documentation to prove your innocence, too bad. So, yes?
One thing, just real quick, I mean, this is for outside of this, but when you're talking about a partnership and you have two partners and they're treated as, they're both revocable trusts, basically, and the partnership is an LLC that's treated as a partnership for tax purposes.
Right.
So if that LLC was to sell property, it'd be very clean if that LLC entity was just doing an exchange as the LLC into another property. Where I'm getting confused is that ultimately, doesn't the deferred tax gain go through the K-1 down to the individual person anyway?
It can. All I'm saying is that you just have to document it and have that information available if you ever do get audited. So yes.
But because the issue I have is that
Right.
we have that situation.
Right.
Well, one of the parties is now telling me they may not want to do a 1031.
Right. Right.
So obviously, we are now faced with the
Well, how much percentage of ownership does
67%. They're the big.
They're the big, okay,
part.
well then that's where you have to, that's a partnership issue because they have controlling interest.
Right.
So they're the only ones that can do a 1031 exchange. The lower